Have you ever imagined having money that goes into your account every month without you having to work for it? Like money that works for you while you enjoy life, travel, or do what you love? Well, it's possible, and I'll show you how with the best dividend ETFs for 2025. Let me tell you quickly, there is a story about a guy who started out investing little, without knowing much, but he chose the right ETFs, focused on paying constant dividends. In a few years, he started receiving money every month, which even covered some extra expenses, and his life changed. And you know what the best part is? You can do the same starting today. In this video, I'll reveal which ETFs are really worth it to guarantee this real passive income, and not those empty promises you've heard so many times. If you want to start 2025 on the right foot and let your money work for you, stay with me until the end, because this opportunity won't wait for you. 1. Vanguard FTSE All-World High Dividend Yield UCITS ETF VHYL. Imagine you are at a giant fair with stalls from all corners of the planet. There are companies from the United States, Europe, Asia, and even from less famous places like Chile or South Africa. Now, at this fair, you only want to visit the stalls that give gifts to their customers frequently. These gifts are the dividends, a part of the profit that companies share with those who invest in them. The why? It's like a super shopping basket that brings together all these generous companies from various countries, especially those that are large, stable, and well-known, as the JP Chase, one of the largest banks in the world, or ExxonMobil, oil giant. By investing in this ETF, it's like you're saying, hey, I want a little piece of those companies that are always making money and sharing it with me. Now look how interesting. You don't even need to choose company by company. VHYL already does that for you. It selects the best dividend payers in the world, and you just need to buy a single quota of this ETF. Ready? You are now part of the group of global investors. And how much do you earn from this? On average, this ETF distributes about 3.05% per year in dividends. This means that if you invested 10,000 reais, you could receive around 305 per year just for being there without doing anything else. And the cost to take care of all this, buying the stocks, tracking the market, keeping the basket organized, Vanguard charges a fee of 0.29% per year, which is considered very low in this world of investments. Summary in very simple language: VHYL is like a big safe filled with companies from all over the world that are happy to share their profits with you. It's perfect for anyone who wants to earn a little extra money every year without having to pick stocks on their own. You invest, sit back, and the dividends gradually fall, like a magic piggy bank that fills up over time. 2. VanEck Morningstar Developed Markets Dividend Leaders UCITS ETF TDI. Now imagine this. You are choosing the 100 most dedicated and generous students at a giant international school, but not just any school. Only countries are allowed developed, that is, well-structured economies like the USA, Japan, Germany, Canada. These students are actually companies from these rich nations, and they were handpicked because they were strong, reliable, and excellent at sharing the profit with their investors. That is, they pay great dividends. ETF TDI does just that. He puts together a selection with the 100 best dividend-paying companies in the developed world, as if it were a dream team of performance. And the coolest thing, these companies not only pay well, but they also have a history of withstanding crises and staying afloat. Among the famous names, you will find companies such as Verizon Communications USA, Chevron Energy Oil USA, HSBC, one of the largest banks in the UK. How much does this yield? This ETF distributes around 4.1% per year. Dividends. more than the general market average. It's as if you earned $410 per year for every $10,000 invested, just from what the companies are sharing with you. And how much does it cost to have access to this champion team? The administration fee is 0.38% per year, a reasonable value to have this premium selection working for you without you having to choose stock by stock. Summary in plain language. TDI is like an elite class of the strongest and most generous companies in rich countries. They hand you more money every year even when the market is tough. It's a great choice if you want good dividends, with more security and less headache. 3. SPDR S&P Global Dividend Aristocrats UCITS ETF GBDV. This ETF is focused on solid and consistent companies known as dividend aristocrats. To be part of this select group, the company must have a history of at least 10 consecutive years paying or increasing dividends. That is, they are companies that even in difficult times do not fail to remunerate their shareholders. The GBDV searches for these names around the world, offering a diversified portfolio with companies from various sectors and countries. The focus here is not only on the value of dividends, but also stability and discipline in payment over the years. Performance: approximately 0.72% per year in dividends, which is a good balance between profitability and security. Administration fee: 0.45% per year, a little higher than other ETFs on the list, but justifiable due to the more careful selection strategy. Direct summary: GBDV is ideal for those looking for reliable companies, which have been delivering dividends regularly for years, with broad international diversification and a history of solidity even in times of instability. 4. iShares UK Dividend UCITS ETF IUKD. IUKD is an ETF specifically aimed at UK shares that offer high dividend payments. It focuses its investments on companies in sectors that are traditionally strong in profit distribution, such as public utilities, consumer goods, and financial services. It is an interesting choice for those who want to expose themselves to the British market with a focus on passive income, taking advantage of the profile of UK companies, which historically value the transfer of profits to shareholders. According to data from April 2025, the ETF had a cumulative return of 5.61% for the year, which shows good recent performance in addition to the dividends distributed. Dividend yield and management fee may vary, but the main focus of this ETF is to generate recurring cash flow from established UK companies. Straightforward summary: the IUKD is suitable for investors looking for exposure to the UK market, focusing on high dividend distribution, especially in sectors that are stable and traditionally generous with their shareholders. 5. Franklin European Quality Dividend UCITS ETF. The Franklin European Quality Dividend UCITS ETF is a fund that goes beyond simply paying dividends. It focuses on investing in European companies that match high financial quality with a consistent dividend distribution policy. Unlike funds that choose stocks only based on the amount of dividends paid, this ETF values the solidity and sustainability of payments, prioritizing businesses that have robust fundamentals and are capable of sustaining and even increasing dividends even in difficult economic times. Focus on dividend quality and sustainability. The core of the strategy is quality. This involves a detailed analysis of companies under various criteria, such as low level of debt. Companies with controlled debts can weather financial crises more safely, avoiding sudden cuts in dividends. Consistent profitability, stable profits, and healthy margins indicate that the company generates enough cash to remunerate shareholders in a sustainable manner. Efficient corporate governance. Responsible and transparent management with ethical practices strengthens investor confidence and reduces risks related to fraud or mismanagement. Solid dividend payment history. The fund prefers companies that have a proven track record of regular and, whenever possible, increasing payments. This set of criteria helps filter out Europe's most reliable companies, those that are not only paying good dividends today, but are likely to continue to do so in the future. Smart diversification. In addition to quality, the Franklin European Quality Dividend ETF seeks a careful balance in the composition of the portfolio, distributing investments between different sectors of the economy. To avoid excessive concentration in a single segment, such as banking, energy, or consumption, the fund diversifies across multiple sectors, reducing the negative impact that a sector crisis could cause. European countries, with exposure to developed markets in Europe, the ETF balances between countries such as Germany, France, Switzerland, and the United Kingdom, among others, to dilute specific risks of each national economy. This diversification offers the investor a more resilient portfolio, capable of withstanding regional and sectoral fluctuations, maintaining the stability of income and invested capital. Performance and cost. A very relevant piece of information for those considering this ETF is its recent performance. Until March 2025, the fund recorded a return of 22.20% in the last 12 months, a very impressive result for an ETF focused on dividends, which generally has as its main objective income generation and not accelerated appreciation. This shows that it is possible to have the best of both worlds, a steady stream of dividends and solid equity appreciation, which is essential for investors seeking growth and income at the same time. As for cost, the Franklin European Quality Dividend has a competitive management fee, usually between 0.30% and 0.50% per year, a value that reflects active and careful management in choosing the best companies to make up the fund. Direct summary. The Franklin European Quality Dividend UCITS ETF is an excellent option for those looking to exposure to the European market, invest in solid, well-managed companies with a consistent history of dividend payments, balancing capital growth and passive income generation, minimize risks through sectoral and regional diversification, count on active management focused on quality and sustainability. This ETF is suitable for both investors seeking a stable income over time and those who wish to increase their wealth with less volatility than traditional investments focused solely on growth. 6. LNG Gold Mining UCITS ETF. This ETF has a different proposition than most dividend-focused funds. It invests exclusively in gold mining companies, known for having high profitability and in many cases pay significant dividends. The gold mining sector is quite cyclic. That is, their results vary according to the price of gold on the international market. When gold appreciates, something common in times of crisis, high inflation, or geopolitical instability, these companies tend to have high profits, and with high profits, many of them distribute a significant portion of these earnings in the form of dividends. The LNG Gold Mining UCITS ETF seeks to capture exactly this movement. It brings together several leading global mining companies, offering the investor a rare combination: exposure to gold, considered a protective asset against crises, and passive income payment. In the last year, up to the reference date 2025, the ETF registered an appreciation of 58 to 91%, which is exceptional. Although it is important to remember that this type of performance is not guaranteed for the following years, it is a fund with high return potential but also higher volatility. Administration fee 0.55% per year, slightly higher than more traditional ETFs, which is expected given the more specific nature of the fund and the risk involved. Straightforward summary: the LNG Gold Mining UCITS ETF is suitable for investors who want to diversify your portfolio with gold-linked assets, seek generous dividends, and increase exposure to a sector that tends to appreciate in times of economic uncertainty. It is a higher risk option, but it can also offer great returns, both in terms of appreciation and dividend payments. 7. iShares MSCI World Quality Dividend ESG UCITS ETF WQDV. WQDV is an ETF that combines three pillars that are highly valued by investors who think long-term quality, consistent dividends, and socio-environmental responsibility, ESG. This fund invests in actions of developed countries, selecting companies that meet strict criteria of financial quality, such as stable profits, low debt, and good management, while at the same time respect environmental, social, and corporate governance practices, which is essential today for sustainable and resilient companies. In other words, by investing in this ETF, you are exposing yourself to a group of companies that has real ability to pay dividends consistently. They are well managed and financially healthy, are committed to responsible practices, which reduces legal, operational, and reputational risks. The ETF has 164 shares in your wallet, which guarantees a robust diversification between sectors and countries. This breadth is useful for reducing risk without sacrificing quality. A dividend distribution is around 2.9% per year, and total administration fee is 0.38%, which is reasonable considering the care taken in selecting assets and ESG filtering. This ETF is interesting for those who want an international portfolio with reliable companies, a stable dividend stream, investing with environmental and social awareness without giving up financial returns. Straightforward summary. WQDV is ideal for those looking for quality companies in developed countries, which pay dividends regularly and still follow ESG good practices. It is a balanced way of investing responsibly, safely, and with a focus on passive income. 8. Xtrackers Stocks X Global Select Dividend 100 UCITS ETF. The Xtrackers Stocks X Global Select Dividend 100 UCITS ETF is a fund that brings together a portfolio of 100 globally selected stocks chosen for their payout high dividends. The main objective of this ETF is to capture the best possible return on the world market, investing in companies that distribute a significant portion of their profits to shareholders. That is, those that actually pay out considerable money every year to those who invest in them. Strategy and operation. Replication via swap. An important difference in this fund is the way it buys this market exposure. Instead of directly acquiring all 100 shares, the fund uses a strategy called replication via swap. Basically, this means that the ETF enters into financial contracts with another institution, usually a bank, which undertakes to deliver the results of these shares as if the fund owned them. This method can bring some advantages, such as reduction of operational costs. Buying and managing 100 stocks in different markets can be expensive and complex, so swap helps to optimize this part. Greater efficiency in index replication. The fund can more closely track the performance of the dividend index it tracks. However, this mechanism has an important point of attention, the so-called counterparty risk. This means that the ETF depends on the partner institution's ability to meet the payments and deliveries promised in the contract. If that institution faces financial problems, the investor may be exposed to losses, performance and costs. The big highlight of the Xtrackers Stocks X Global Select Dividend 100 is its very attractive dividend rate, around 8.38% per year. This yield is significantly higher than most dividend-focused ETFs on the market, making it a very interesting choice for investors looking for high passive income generation. As for the management fee, the fund charges approximately 50% per year, a value considered fair for a product that offers this global diversification and focus on high dividends. Who is it suitable for? This ETF is ideal for investors who, do you want one? Globally diversified portfolio with exposure to multiple regions and sectors. They seek high dividends, prioritizing the generation of passive income above the market average. They are willing to accept a little more complexity and additional risks, such as counterparty risk, due to the swap replication structure. In short, the X-Trackers Stocks X Global Select Dividend 100 is an excellent option for those who want high passive income and are comfortable dealing with slightly more sophisticated financial instruments, understanding the risks involved to maximize their gains. 9. Wisdom Tree Europe Equity Income UCITS ETF EEI. This ETF is focused on European companies that pay the highest dividends, but with an important filter. In addition to the dividend value, it selects companies based on quality and moment. In other words, it is not enough to pay well. The company needs to have solid fundamentals and be in a favorable moment to maintain or increase these payments. Another important difference is that the EEI prioritizes companies that also serve ESG criteria, environmental, social, and governance, which reinforces the commitment to sustainability and good corporate management. The fund has an average dividend yield of 6.2% per year in the last 12 months, which is quite attractive for investors focused on passive income. Finally, it is important to remember that dividend-paying ETFs, such as EEI, may imply immediate withholding of taxes at source on dividends received. Therefore, European investors should consider whether they prefer distributing or accumulating ETFs according to their tax situations to optimize their earnings. Straightforward summary: Wisdom Tree Europe Equity Income is a good choice for those looking for exposure to Europe's best dividend payers, with a focus on quality, sustainability, and an attractive return. Ideal for those seeking a stable income and concerned with responsible practices. 10. Invesco FTSE RAFI US 1000 UCITS ETF PSRU. The Invesco FTSE RAFI US 1000 UCITS ETF is a fund that invests in the 1,000 largest American companies, but with a different approach. Instead of following the traditional market value weighting methodology, it uses the RAFI Research Affiliates Fundamental Index methodology, which selects and weights stocks based on fundamental metrics such as sales, cash flow, dividends paid, and book value. This ETF has a special focus on companies with strong dividend generation and solid fundamentals, which helps identify companies that can offer a stable income and dividend growth potential over the long term. The fund covers a wide range of sectors with broad diversification that reduces risk specific to a segment or company. This includes sectors such as technology, healthcare, finance, consumer, and energy. When it comes to dividends, PSRU offers a yield that typically ranges between 2.5% and 3.5% per year, depending on market conditions. In addition, the fundamental methodology tends to favor companies with robust cash flow and sustainable payout, important for the continuity of dividends. The administration fee is around 0.39% per year, which is competitive considering the fund's differentiated strategy. Straightforward summary: the Invesco FTSE RAFI US 1000 UCITS ETF is suitable for investors who want broad exposure to the US market, but with a more careful focus on fundamentals and sustainable dividends. It is a good option for those seeking a balance between growth and income generation. Investing in dividend ETFs is one of the smartest and most practical ways to build a consistent and diversified passive income around the world. As we have seen, each fund has unique characteristics that meet different investor profiles and objectives. If you are looking for global diversification with stability, the Vanguard FTSE All-World High Dividend Yield (VHYL) is an excellent choice, combining large companies from developed and emerging markets with good performance and low costs. For those who want a greater focus on quality and resilience, the VanEck Morningstar Developed Markets Dividend Leaders TDI, and the SPDR S&P Global Dividend Aristocrats, GBDV, are ideal because they invest in companies that have maintained or increased dividends for years. If your interest is in high income, the X-Trackers, Stocks X Global Select Dividend 100, 8.38%, and the Wisdom Tree Europe Equity Income, a 6.2%, offer more robust dividends, but with specific risks such as swap exposure or regional focus. To diversify sectors, the LNG gold mining ETF brings exposure to a unique sector with the potential for high returns in periods of volatility. And for those seeking socio-environmental responsibility combined with dividends, they shares MSCI World Quality Dividend ESG, WQDV. It is a modern option that combines profitability with sustainable practices. Finally, the Invesco FTSE RAFI US 1000, PSRU, stands out by combining a fundamentalist methodology with a diversified portfolio of the American market, offering a balance between growth and income distribution. In short, the best ETF for you depends on your profile, goals, and risk tolerance. Evaluate yields, costs, sectors, geographic exposure, and even tax issues to build a dividend portfolio that generates stable income and long-term growth. If you liked this content, leave a like, share, and subscribe too. Receive more tips on investments that really make a difference in your financial life.